$50 for something worth, let's say, $70 can be a bargain deal. Likewise, investors often hunt for such undervalued stocks in the equity investment world, and this approach is known as value investing. However, spotting quality undervalued stocks can be a tricky job. Firstly, you have to understand that undervalued does not necessarily mean cheap. The former are stocks that are trading at a lesser value at the current price levels than their actual value. So that said, let's take a look at the aspects of undervalued stocks, including why they are considered undervalued, whether they're worth exploring, and how you can smartly spot them. Now, as for why stocks are undervalued in the first place, well, there could be a number of reasons triggering this drop in value. They're generally either company-specific or sector-specific. Company-specific reasons can be quarterly financial results, merger and acquisition news, expansion plans, and much more that could trigger any positive or negative movement in the stock's prices. For instance, stocks of e-commerce infrastructure firm Spotify dropped by over 14% on May 5th after its first quarterly financial year results were released. In the case of undervalued stocks, missed analyst expectations in quarterly results, competition, legal issues against the company, and much more could result in a freefall. But some of these factors, like financial performance for example, can improve with time depending on the company's ability. Value investors can analyze the severity of the cause and ensure that the underlying business of a stock is robust enough to rebound in the long term. Now, when it comes to sector-specific issues, some sectors are cyclical in nature and hence more vulnerable to the market cycle than other sectors. During the downtrend phase of the market cycle, companies in these sectors could witness their stock prices fall even to record lows, despite robust business fundamentals. Quality stocks that are trading at discounted values can minimize exposure to fluctuation to a certain extent, especially during a market correction. A theoretical argument behind this is that undervalued stocks are already trading below their true value, in contrast to overvalued stocks, which can plummet to their intrinsic value. What's more, these kinds of stocks could have less of a negative impact, and they may even outperform growth stocks in a weak market environment, which of course can help you prepare for economic downturns. Although not all stocks with low price-to-earnings ratios are quality undervalued stocks. Key metrics like return on equity, debt-to-equity ratio, and current ratio can collectively help you assess a stock's health. Plus, investors should be checking financial and operational results to ensure that the underlying business and its future outlook are strong. These factors will help investors assess a stock's intrinsic value and help them evaluate if it could potentially grow higher to that value in the near or long term. Now that you're up to speed, hit that bell icon to stay updated and boost your financial IQ. I'm Holly Shields for Kalkine Media.